Well, hello everyone. Welcome to Trading a Smaller Account and a fresh new week in the markets. My name is Barbara Armstrong, and today we are going to talk about short put verticals. We're also going to talk about buy right covered calls, and specifically on short put verticals, we're going to look at several new example trade setups and why in looking at a stock we might choose a short put vertical. We're also going to look at a little bit of trades gone wrong, and we now have an example trade that we put on where it expires on Friday, and that stock is currently trading in between the strikes. Now, if you're not familiar with this strategy, not to worry. I'm going to do a brief overview of what it's about, but I'm also going to talk about the importance of managing trades and closing them out prior to expiration, and why that might be a critical part of our successful trading in strategies like these short put vertical strategies. So I want to thank Mike Fairborn for being here with us today. He's a friend and a fellow coach, and he understands the strategies that we are going to talk about in spades. I also want to thank all of you who come in and often like 15, 20 minutes early, and you're here like kibitzing in the chat and greeting one another. And it's really a wonderful community. And so thank you to each and every one of you that's here and so participatory. If you are new to all of this, feel free to type a greeting into the chat so that we can welcome you, along with Jose and Dom and Josh and Janet and Jackson and Mike and Marcus and Life in the Fast Lane. I love some of these handles, and Sharon and Riceburg and APA and Ray and the rest of the gang. Thank you all for being here. Okay, so if you are not following us on X, you are missing out. Consider this my formal invitation from me to you, or from Mike and I to you. My handle, Barbara Armstrong CS. Mike's is Mike Fairborn CS. So it's another free resource and a way for me to be able to communicate with you, and you to be able to communicate with Mike and I outside of things like this. Chris is asking if we'll talk about Mickey D's. Yeah, you know what? I'll put that one on my list, because we had an iron condor on that. And it's kind of in the potential to be a trade gone wrong, but you know, sometimes we just have to be a little patient. Okay, so before we get into the thick of things, just let me remind everyone that we do a lot of options trading in this class, and know that options carry a high level of risk and aren't suitable for all investors. Also, we use the Paper Money software application on the Thinkorswim desktop platform. And it is a brilliant place to learn and grow and hone your trading skills, become familiar with the platform. But there are some nuances and differences. One is that short option positions will never be assigned early. We're going to talk about that today, because we have some short option positions that are in the money. And, although short option positions can be assigned at any time, the likelihood goes up when they're in the money, and particularly if they're in the money approaching expiration. All righty. So, one of the things that I don't spend as much time on as I used to is doing a market overview. But when we look at, I've been gone, the last couple of trading days. I was gone Wednesday through Friday of last week, and we can see that the S&P 500 continuing to move to the upside. Now within a stone's throw of that February high, after some this period of darkness, shall we call it, back in March and April. And when we look at the NASDAQ, it's pretty similar, isn't it? We have this deep V pattern, or we had a bit of an inverted head and shoulders pattern setting up on Friday. Things pulled back and now moving to the upside again today. When we look at the Dow 30, we're seeing these recurring themes, right? Now with this one, if we wanted to look at an inverted head and shoulders pattern, we have this pattern setting up, but it hasn't kind of broken above the neckline yet. So it's kind of doing a bit of lollygagging about or a bit of consolidating here. But, it's the 30-day moving average is kind of caught up and seems to be acting as a support level. Inside day so far today, we call that a Harami pattern, and it's considered to be a bullish pattern when it happens at a support level. But, just because a bullish pattern happens doesn't mean that it will necessarily follow through. This is our small caps. And now this one, and if you're not familiar with some of these patterns, I do teach trading a small, getting started with technical analysis on Tuesdays. Feel free to join me tomorrow for that one. I'm just trying to wake up my drawing tools here. Just give me a sec. Priya is asking about how to open and close options on your iPhone. If you go to Trader Talks and do a search on that, there are some in the archives. But I don't have the capability of demonstrating that with the setup that I currently have here. So, but this is one of the reasons you want to subscribe to the channel. So this is what I mean by an inverted head and shoulders pattern. And on the Russell, we see that we have this pattern and it has broken out and then come back to retest. And so this is considered to be a trend, a potential trend reversal pattern. And, some would say, okay, I'm going to measure from this 1740 to this 2114, 1740, 2114. So they might be expecting about a 374 point move to the upside, which if I take 2113 and add 374, that'd be about 2487. That would be a new high for this market at 2487. Okay. So, but this is a bullish configuration. So it looks like, the bulls are back in town, the bears are back in hibernation, and Chicken Little's been resting now, for these many weeks. And the bulls are happy about that. Okay. And our volatility index, back just chilling under 20, so, all good news for the bulls. Now, somebody asked if I would take a look at Mickey D's. So on McDonald's, we had done an iron condor. So an iron condor is basically, I think of it as a credit spread sandwich. And so we did a short call vertical here at the top, and then a short put vertical here at the bottom. And with this short put vertical, what happened, we put it on when it was trading around here, and then it broke to the downside. So we closed out the short call vertical piece because we had the majority of our profit. And then it came down while I was away, and it was just kind of flirting with this 295, 290. I don't know what's going on today, but and our strikes are at 295 and 290. Oh, this is 300. Sorry. So I need to make this 295. So, this is not looking so hot. And today's candle's really not looking good. So is there news out on McDonald's? So there's been some lawsuit over ad spending. So they've reached some kind of agreement on that. And so who knows? It's looking very bearish today, but who knows where it'll be? This expires June 27th. So when we come and we look at the chart here, it's at 300 and 295. So, and where's it currently trading? It's currently trading at 296.85. So let me go and fix that. Edit. So we're at 300 because it had been so bullish. It hadn't really come back down below that. 300 and 295 is where these strikes are. So we are in between the strikes. And this can be a problem. Now we have a couple of weeks, so we may not want to overreact. We aren't going to do anything with this today. But if this were the expiration date, what would happen? And let me just change this to 295 because our strikes are at 300 and 295. And so what we were expecting to happen is that this was going to stay in this range. And the reason that we did, I'm just trying to bring my drawing tools up again. Come on. I don't know why this is so slow. Huh. You know, it's the French Canadian in me. To not have a drawing tool that's working is pretty disconcerting. Okay, so I've got the reason we did a short call vertical here. Let me just see if I can, because we were expecting it to stay below here, below 320 and above 300. And if this were the expiration date and we did nothing, this short, because this is in the money, the short put would be exercised and we'd be buying, 100 shares of McDonald's at $300 a share. And then the strike that we bought, which allows us to sell it at 295, so that helps us define our max gain and our max loss, that would expire worthless. And so, this is a problem, people, because now, if that's assigned to us on Friday and the stock tanks over the weekend, now we could lose more than our max loss, our theoretical max loss, if this strike is assigned and this one expires worthless. The other thing is that we have a $25,000 account. And so if we get assigned $30,000 worth of stock, we don't even have 30,000 in the account. And so the problem becomes like, oh, oopsie, we're going to get like a little call coming saying, hey, Barb, time to put some more money in your account because you've just bought more than, you've just spent more than you have. Now, some brokerage companies, to help manage their own risk, because you can't get blood from a stone, who knows if you have more money to deposit, they might go ahead and liquidate that position, but you'd want to talk to your broker about how they handle it. You don't want to count on that. And they may not do that. So we're in a position of risk here, but we have a couple of weeks to expiration. And so we can see that we had here was a support level. And then here's another support level here around that 295. So we'll just see, and we're seeing it's coming back up a bit off the bottom if we go to a 1 day, 1 minute. But wow, today it has been falling. Looked like it kind of jumped out the window, right? Or, it caught an edge on a black diamond run and it has been like tumbling head over heels down that hill. Okay. Okay, so that was that one. Somebody asked me to look at that, and that's, an important thing for us to look at. Let's look at one other position. So here's kind of a trade gone wrong. We're down 150 on that. Now we'd have to balance that against the other side where we made money. So net on this trade, we're not down 150 in total yet. So we'll see how that goes. CMG, that one's clipping along. We sold a put, so we were bullish on that, and CMG must be up today. But the one I wanted to look at, oh, look at that. It is up today. Just so you know, I did buy several $100s worth of Chipotle Mexican Grill on the weekend. Yeah, so you're welcome, to us for that. So that one we're just going to let percolate. We have an exit in place when we have 80% of our max gain. Now, but the one I wanted to look at was Celsius Holdings, because we're in the money on this. And this is one, CELH. So we bought this back on April 2nd. And then we bought it and we sold a protective put and a covered call. And the first covered call we sold was at 40. Sorry. So we had sold a covered call at 40. And then we bought it back for a pittance on this day when it had pulled back. And we also closed out the protective put. And the net of it was that we were up by $100. And then we sold another one and we closed it out, another covered call, and we sold that out and we made about $80. So in total, we're up by about $180 on the covered calls that we've sold, less the protective put that took us over earnings. And then this thing has kind of taken off. And when it got up close to this previous high, we sold another covered call. It went up through our strike at 42 and then pulled back. And then look at it today. I mean, it's up almost 6%. And this expires Friday. So are you going like, oh, are we kicking our butts for selling that covered call? No, we bought it back here. We're up $555, which on a $25,000 account, $500 is 2% plus of the whole account value. So like, this is not a base hit, my friends. Like, this is a bases loaded home run so far if we were to exit it today. Plus we made another $180 on this previously that we have realized as gains. So we can do a couple of things. We can say, and watch your language if you say this to yourself, this is fantastic. There's no way this is going to go back below 42. I'm just going to allow it to be called out. Yeah. If you think that, be afraid, be very afraid. Okay, so that's not a great thing to think, but we could do that as a strategy. Just let it go. If we're called out, we're called out. And if it comes back below 42, we get to keep this $1.20 and we do it again. Okay, so Isaiah is saying, well, what about if we roll it? And I like the way you're thinking. I don't tend to be a roller. Or, he's saying, or take the profit. So, I was kind of leaning towards, well, let's take our profit because we've done really well. We bought it for 37. We'd be selling it for 43. We're up 15% on this stock position, but if we rolled it out, could we roll it out to July and get a credit and maybe roll it higher? Oh, sorry. Let's just look at this. We're going to create a rolling order, and they call this a calendar. But what we're basically doing is we sold the June 20th, so we'd be buying that back, and it will default to the next closest expiration date, and it'll keep the same strike. What if we went out to July? Well, July, it doesn't trade the 42, so I'm guessing it just trades $5 wide strikes. Oh, 250. So we could sell the 45 because it's already in the money at 42.50. But could we come out here and roll it to the 45 and still get a credit? Well, let's see. And then if we are called out, we're not getting much of a credit, but we get another $3. And $3, my friends, is not nothing. Because we only paid, we paid 37 something for the stock. So let's say we paid 38, I'm rounding up to make it more conservative. And if I divide that by the extra $3, if it went up to 45, so sorry, if 3 divided by 38, that's another 8%, 7.89, call it 7.9. So if we can get even a 16-cent credit and then, continue on with this position, that might work out. Now, the one thing I want to do before, well, we don't have an exit in place on this, so we can just roll this. So on this one, we're going to roll. So on Mickey D's, we were hanging tight. On Celsius, we rolled. And Harry is saying, take the profits. And so, you know what? We may come back and look at this again on Wednesday, or next Monday. We don't have to stay in this. And nobody would fault a trader for saying, you know what? I have a $25,000 account. We're up over $600 in total, 800 and some on this trade. We're just going to take the money and take our unrealized gain and turn it into a realized gain. Okay. So I want to look at some new opportunities now. And just so you know, CrowdStrike, we had done a short put vertical on and it hit our target. So we're out on one of the CrowdStrike trades. We're out on a trade that we did on NVIDIA. It was we did a short vertical on NVIDIA, and we had sold a short put on Supermicro. And we're out on that. So with Supermicro, could we do that again? And this is a stock where the volatility is high. And so if we come to the trade tab and we look at this, Supermicro, if we come out to July, volatility is at 73%. It is a $44 stock. And the volatility is at 73%. And so if we look at that, what does that mean? Well, it means if we're selling an option, and we did a couple of things, like on Supermicro, we had sold a put. And I think we'd sold a put, well, let's see. We had sold the 39 put. Now, we'd sold the 37 put earlier, and it had been put to us, and then the stock really went up, and that ended up working out well for us. We sold a covered call. So then we sold the 39 put. And we got paid $1.99 for that, or $2. And we ended up buying it back for 30 cents. And we had put in an exit on that. So could we do something similar? Look at that. It's now at 43. Could we move this to 39 and say, hey, if it came down to 39, I'd be willing to own it. Now, when we sell a put, we're agreeing to potentially buy the shares. Because if the stock is put to us, and when we sell a put, it says, hey, if you'd like us to buy 100 shares of SMCI at $39, we're in. We're okay with it. And sometimes we don't want to do that. We just want to make the money. But if you know that under no circumstances would you want to buy SMCI, then you may not want to sell a put. But if we looked at this, how much premium could we get if we came out here? Well, if we could get $1.46 and end up buying it at $3.71 below, what would our break even be? It would be 39 minus $1.46. So it would be like $37.50, the equivalent of buying it for $37.50. So we could do that. We've got lots of volume here. We have a very tight bid-ask spread, but we could end up owning the stock. And so if we wanted to do that and say, okay, we want to just sell a single. Now we can sell, with a buyback. I tend to put them in this way. I'm just going to sell a single, and then I come to single order. I change it to first trigger sequence. I'm going to right click, and I haven't posted an example trading plan yet, but might say, hey, I'm going to put in an exit when I've got 80% of my max gain. So when this is worth about 29 cents, I'd like to buy it back. And I just took that $1.46 or 15 cents, and made it 28. 14 times 2 is 28. And then added a penny to cover the 6. So I'm selling a covered call. Now, is there another way we could approach it? Well, we could do something like we did with Celsius. And actually, if we do this, it's in essence creating what we call a covered strangle. And a covered strangle, it's just kind of a fancy word. But a covered strangle occurs when you buy 100 shares of the stock, sell a covered call, and then also sell a short put. We have a lot of money sitting in cash here. So we're going to just kind of compare these two because it's kind of, it was consolidating here. We had a bit of a triple bottom. It broke out. It's consolidating again. And if we look at this and say, okay, I could see this, it could continue to go sideways. It could go up. It's sitting at 43. What if I sold the 45 or the 46 out here in July? We've got lots of volume. Now, the closer the strike is to where it's currently trading, one, the more premium we'll receive. But then if we're called out, the less, we're agreeing if we buy shares of stock and sell a covered call at 45, we're agreeing to sell the stock at 45. Where if we come out to the 46 strike, the odds of it being in the money go from 41% to 37%, but we receive less money, like, 37 cents less. But if we're called out, we make $1 more. And then again, if we come out to the 47, we have a 33% probability of it being in the money, a 70% chance of it touching, based on where the stock is currently sitting. And then instead of getting paid $3, you'd be paid $2.30. But if you're called out, you'd get 47. And so if we said, you know what, let's go for this 47 strike. And in the parlance of Thinkorswim, we call it buying covered stock. So we're buying 100 shares, covering it with a covered call. And somebody in one of the comments today, so if you're watching this in the archives and you're saying, like, I have a question, well, you can put your question or comment. And somebody's comment was, I get really frustrated when I buy shares and sell a covered call and then I get called out. But our goal here is to be called out. So if we're called out, we're totally okay with that because we'll have made a bunch of money. How much money? Well, how much money is a bunch? In this case, it is 47 minus 41.44. That's the most we can make, minus 41.41. So the most we can make is 559, but we're paying 41.42 to get in. So if we make 559 divided by 41.40, that's a 13.5% return. Yeah, I see you guys asking about Nutanix, and that's another one that's in between the strikes. I will look at that, NTNX. So not to worry, but I wanted to play some new trades first because we always have people that are brand new. And I know if I had been away for a while, because I started as a client and came in and they were just talking about all trade management, it's like, oh, dang, I don't have any of those trades in my paper money account and would lose interest. So I'm trying to balance it. Okay, so if we look at that at 41.42, and then we come out to the charts and we say, well, how would where would I be concerned that this is no longer uptrending? I would say, well, it's come down here and hit twice around 39. So if it went 3% below that, so if I took 39 times 0.97, put my stop at 37.83, how much am I risking? Well, I'm risking 37.83 minus 41.44. So I'm risking $361, and we don't really want to risk more than 500. So we're within our tolerance, and this position, is costing us 4,000 to get in. We don't want our max position size to be over 5,000. So I'm going to go to single order, first trigger sequence, right click, create an opposite order, which I'm going to make a market order because I don't know what the call will be worth. I know it'll be worth less, but I don't know exactly what it'll be worth. So I'm just going to say, hey, if this stock goes down below 41.43, get me out. It was 41.40, wasn't it? 41. No, it was 39 times 0.97, 37.83. 37.83. If it goes below that, we want to lick our wounds and exit. And this is where it's important to just have made the decision before you get into the trade to say, hey, if this does not go according to plan, this is when I say this has not gone according to plan and I exit. But it's saying, we could lose this entire amount we're paying to get in. It's not taking the fact that we have an exit in place into account. But, if the stock gap down, we could get hurt. We could get hit harder than that. There's not a guarantee that we're going to get out at that same price. And we're going to compare this to our short put. And actually, just kind of as an aside, so selling a buy right, and a short put equals what they call this strategy a covered strangle. So if you're wondering, if somebody says, oh, I love doing covered strangles when the market is really bullish, you can now say, oh, I totally know what that is. I have an example of that in my Pippa Money account. So there you go. Okay. So I wasn't planning on doing that, but there we go. And CELH, we've done that one. Okay, let's come and look at NVIDIA because, we've done a lot of wash, rinse, repeat is what we call it in this class. Where we have a stock that's been uptrending, and we did that with, I think, Goldman Sachs, and we had done like 5 or 6 trades in a row. We'd get out of one, and then if it was continuing to go up, we'd look at another one. And so we had a short put vertical on NVIDIA, and we exited that. And we could do a couple of things. We could say, well, if we think it's going to keep going up, we could do a long call vertical, or if we're, just trying to be a little more conservative and say, well, even if it continues kind of going sideways, maybe I could sell the 140. It's trading at almost 146. And this idea of if I sell the 140, and if we wanted to go out just 3 weeks to the 11th, we still have lots of volume here. The probability of it being in the money, it's saying, is 33% based on current volatility. And I mean, it's a complex mathematical equation. But if we came to this 140, and we've got $6 worth of wiggle room, 140, 138, we get 52 cents. So that's a potential return. And we're risking, 148. It was much higher a little earlier. That's 52 divided by 148. It's about 33%, 34. it's a potential return of 35%, for a trade we're in for 25 days. So if you want to see an example trading plan, I'll show you where to find one momentarily. But we're going to do how many of these? Well, we're risking $150 a contract. So we're going to do 3 because we don't want to risk more than $500. And if we do 3, we're risking $444. And then we're going to put our exit in to buy it back when it's worth about 10 cents. And this is a short put vertical. And with short put verticals, our expectation is that the stock is going to stay above the higher strike, the strike we're selling. So if we come out to the chart here, the expectation, if you want to see it on the chart, and I like to put these on the chart just so when you come to check your positions, you can see immediately, what you are expecting to have happen so that you can then manage the damage if it doesn't. So, the nice thing about a short put vertical, and let me just come in here and we'll add some price access. We'll add some space to the top. So if this continues to go up, we're happy campers. If it goes sideways, happy campers. And we have $6 worth of wiggle room, so it can even come down a little bit. And, we are still happy campers. And I don't know what it is that I can't get my drawing tool to come up. Oh, here we go. Yeah, so if it goes up, we're happy. If it comes sideways, we are still happy. We are happy. So we've got $6 basically worth of wiggle room, and we're still smiling, maybe a little bit of a grimace. We're getting a little concerned. And then if it comes below, this is not going according to plan, but we position sized appropriately so that we're not blowing up our account if it does go wrong. Now, let's do one more example, and I have several set up here. So Meta was one, and we'll do more of these on Wednesday. So Meta kind of looked like the rest of the market, right? Like pulled back pretty dramatically from, the middle of February through, in this case, the middle of April. And then it started to take off like this deep V pattern. Some might say a bit of an inverted, but it's a sloppy head and shoulders and has broken out. But could we come back here and maybe sell something around 680? This is a very expensive stock. So the idea of selling a short put, if this was put to us at $680 a share, like we couldn't begin to afford that. It's a $68,000 position for a $25,000 account. So we don't want to put ourselves in that kind of risk. But if we sell a short put vertical at say 680 and 675, then our max theoretical loss is $5 a share. The difference between the strike we sell and the strike we buy for protection, and what we get paid. So if we're being paid $1.55, what are we risking? Well, we're risking $5 minus the $1.50. So call that $3.50. So our potential return on risk on that is 44%. And we've got $20 worth of, $18 currently worth of wiggle room. And if we see this as kind of a bull flag pattern, we're making this decision based on our technical analysis. And our sold strike would be here around the 680 mark. And so if we're okay with that, how many would we do? Well, we'd only do one because we're risking how much? we're risking $345. And we might go to 550, but we don't want to risk $700 on one trade. That breaks our position sizing rule. And that's a rule we don't break. Okay. So first trigger sequence, we're going to right click, create an opposite order and say, because we could be out golfing or we could be in the pool or doing whatever. And so when we've made about 80% of our max gain, we'd like to buy it back. And we're going to put that in our short put vertical bucket. Now, when we come and look at our short put verticals, and this is something we monitor daily. So here's our short put verticals. And I've had a couple of people ask me about NTNX because we are underwater to the tune of $240 on that. And if you see a little in the money thing here, what does that mean? It means that expiration is this week. And this one has now gone through both strikes. And we're underwater. Now, are we at our max loss? No, we're at $1.80 and we have 2 contracts. What would max loss be? $2.50. And that kind of blew my mind when I first saw this, that I just thought, well, if it's through both strikes, I've automatically, I'm snookered. But what we're seeing here on this is that it broke below here. And then on Thursday, we had this inverted hammer and it looked like, oh, well, maybe is it finding support because it's been kind of at that level before. But it expires Friday and we're through both strikes. And so we might just say, you know what? I haven't incurred my max loss. I still could lose another $150 on this. So maybe what I want to do is take my lumps and choose to exit, because this trend, I'm not seeing, an inverted hammer. I'm not seeing a Harami pattern. I'm just seeing red, 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 red. And so on this one, we're going to come up to our working orders and we're going to come to Nutanix. The plan was to buy it back for, buy this spread back for 12 cents. That didn't quite go according to plan. Now we're paying $1.83. And so, when we look at this, do we say, wow, we really suck as traders? Do we say that? No, this was just a trade. Like if we go back and we look at when we put this trade on, so we put this trade on June 4th, on this day here. So we had something that had come up, pulled back, was marching up the hill. So did this entry make sense? Yes. Did these strikes that we chose make sense? Yes. And are we managing it according to our guidelines? Yes. Somebody's talking about the RSI on NVIDIA. So the RSI, we're at a high end here for relative strength. And we've had this really big move to the upside, and it was in the overbought, and it's now kind of flirting with the overbought lane. But sometimes things can stay in a range like this for quite some time. And so we're looking at this. This is a 2 to 3 week trade. It's not like we're looking to add this to our portfolio. Yeah. So somebody's asking me a question on return on risk. Yeah, part of the reason that we choose the return on risk that we do is because that we know that if we take it at 80% profit, it's going to knock a bit off that. So if we come to NVIDIA, and we just look at this one here. So we opened this one, we got a 45-cent credit. We bought it back for 9 cents, right? Which was our goal. And so what did we make? Well, we made $36 a contract. Okay. I need my drawing tool for this. So we made $36 a contract times 3. And if we look at that, 36 was our net gain divided by, dang it, these drawing tools are driving me bananas. Epic Pen. Maybe now it'll come up. Okay. This 36 that we netted on this, divided by what were we risking when we got in, $1.55. Divided by $1.55. That's 36 divided by $1.55. About a 23% return on our risk. And that's not unusual for a short put vertical. And then we did that times 3. So I'm not taking transaction costs into account, but that's about $118. And for us, you know, that's a base hit in this account. So guys, we are out of time. It goes by so dang fast. We're going to practice, you know, if you wanted to practice these types of bullish strategies, you could look at Microsoft, you could look at Oklo, you could look at PanW, you could look at Ulta, you could look at Starbucks. And we'll look at some of these, you know, on Tuesday and Wednesday. The markets are closed on Thursday, but thank you for joining us. Thank you for being so participatory in the chat. Hit the like button, subscribe to the channel. I do believe there is a survey today. Yes. So, and here's the deal with the survey. So if you click on that link, and I've just reposted it, there's 2 questions. 1, I hated it. 10, I loved it, and everything in between. Yeah, and if you put a comment in, I promise to read it. Follow us on Twitter. Have an awesome day. Stick around. James Boyd up next. Thanks to Mike Fairborn and the guys behind the scenes. Take care, everyone. Bye for now.